Hello everybody, this is Philipp Jonas for Kalamazoo Valley Community College, and today we're going to discuss saving, investment, and the financial system. In macroeconomics, the term financial system refers to something very broad. It's the entire set of institutions within an economy that take the savings of one group of people and make them available to be borrowed for investment purposes by another group of people. In other words, the financial system makes it possible so that if you, for example, want to start a business or build a house, you don't need to save up all of that money to be able to finance it out of your own funds. Or conversely, if you would like to save for retirement, you don't have to do that by building businesses and owning real estate, but you can also make your savings available for others in exchange for a rate of return. Now, within that very broad term of the financial system, we have two major subcategories. The first are the financial markets. Their hallmark is that the savers and the borrowers directly interact with one another to make a deal. There are many types of financial markets in our economy, but we'll focus on two big ones. Number one, the bond market. The bond market trades in certificates of indebtedness. The saver makes loanable funds available to the borrower in exchange for typically a guaranteed interest rate. And should the borrower go bankrupt, the bondholder is among the first people that needs to be repaid. That makes bonds relatively safer for the saver, but as we'll discuss in our next lecture, should also lead to them having a lower rate of return on average. The second major type of financial market we'll discuss is the stock market. Here, the saver provides loanable funds in exchange for partial ownership of the firm. So rather than being guaranteed a fixed interest rate, they are guaranteed their share of the profits of the firm. If the firm does great, that could be a lot of money. If the firm goes under, that could be nothing. And if the firm goes bankrupt and its various stakeholders are repaid, stockholders are among the last that get paid. So it's entirely possible that they lose money on their investment or even get nothing back at all. That makes stocks more risky. These are the financial markets. The second major subclass are financial intermediaries. Here we have an entity in between the saver and the borrower. So the saver gives their money to the intermediary, and the intermediary then actually provides it to the borrowers with varying amounts of discretion. A classic example here would be a bank. You can put your money into a savings account, and as far as you're concerned, you have a deal with the bank now. They owe you a certain interest for that. But you know that the way the bank makes money is that they take those funds and lend them to somebody else, maybe to buy a house for a mortgage. But you will never know to whom they lent that money. You have no say in the matter of how they do it. That transaction is completely separated from you. That makes the bank an intermediary. Another major category of intermediaries are so-called mutual funds. These we often think of as buying a basket of stocks and or bonds, but what we are actually doing is buying a share in a firm which in turn buys stocks or bonds. We'll discuss these more in the next lecture. Some mutual funds, the managers have considerable discretion. It's more like a bank. They decide what to buy. Others nowadays, so-called index funds, have a very firm set of rules on what they buy, so there's almost no discretion there on the part of the manager. And then finally, while there are many types of financial intermediaries in our economy, let me highlight one more big one that sometimes flies under the radar: insurance companies. Insurance companies make a considerable amount of their profit from so-called float, which refers to the fact that when you buy insurance, let's say car insurance, premiums are paid up front, but claims always happen later. So in between, they sit on these premiums that they might expect to have to pay out in claims, but can make a profit from investing in the meantime. that makes an insurance company closer to a bank than we sometimes realize. So together, these financial institutions and financial markets form our financial system, allowing savers and borrowers to interact with one another. So let's talk about how we define this at the macroeconomic level. At the macro level, there are two major sources of savings in our economy. The first type we call private saving, and it's probably what you think of when we use the term saving. It refers to the fact that households earn income, but not spend all of that income on consumption. Using standard algebraic notation, we define private saving as y minus t minus c. The y is familiar to you. It's the GDP of our economy, which we can think of as all household income. And the c, of course, is consumption. Capital T is a new algebraic symbol for us. It refers to taxes. Anything households pay in taxes, by definition, is not being saved. The second major source of saving is referred to as public saving. This is the saving that the government engages in. However much more it takes in taxes than it spends. Or using our algebraic symbols, T minus G. Now you're probably aware that governments quite often run so-called deficits. Their spending is greater than what they take in taxes. In that case, public saving becomes a negative number. But we always talk about it in terms of public saving, even if they are actually borrowing. We refer to that as negative saving. It's more rare, but the same thing can happen to private saving. It's possible for private saving to be a negative number. These are the two sources of savings in a macroeconomy. And if we refer to them collectively, they are referred to as national saving. So that's simply the sum of private and public saving. But let's have a closer look at the math here. Private saving is defined as y minus t minus c, while public saving is t minus g. If we add these two terms together, we can simplify a little bit. Minus t over here cancels out with plus t over on the public saving side. So national saving can also be written as y minus c minus g. Or in other words, it's all of our national income that is not used for consumption or government spending. Basically, it's everything we produce that we don't use for the now, but that we produce for the future. That's the fundamental nature of national saving. And that is 1/2 of what our financial system does. Accumulate this national saving and then make it available for investment spending somewhere else in our economy. And it turns out there's a very strong mathematical connection between those two, saving and investment, that I'd like to show you. Let's start with the fundamental accounting identity of GDP. GDP equals C plus I plus G plus NX. Now, at this point in our course, we're going to treat our economy as closed, meaning one that doesn't interact with the rest of the world. That eliminates one of the terms from our national income accounting identity. For a closed economy, Y equals C plus I plus G. There's no net exports if there's no rest of the world we're interacting with. Of course, we're going to put the rest of the world back in a future lecture, but it's going to complicate this math a little bit. So let's start with the simpler version that'll still get the key insights across. So here's our national income accounting identity for a closed economy. And just like with any other algebraic equation, we can manipulate this, rearrange the terms a little bit. Let's go ahead and solve this equation for I, investment spending, since that's one of the things we're interested in today. So I'm going to subtract C and subtract G to move them to the other side of our equation. Investment spending in a closed economy is equal to Y minus C minus G. But that should look a little bit familiar. Y minus C minus G. We of course just saw that term on the previous slide. That is national saving. So in other words, for a closed economy, we've got a really strong mathematical identity here. For a closed economy, national saving, which is often just called saving in macroeconomics, is equal to investment spending. If you want to, you can think of our financial system as the equal sign in between saving and investment. It's the set of institutions that funnels those funds from one side to the other. And today we're going to discuss a type of model we use in economics to make sense of that equality. This class of models is called supply and demand. And if you've taken another economics course before, that'll probably be pretty familiar with you. If not, do pay special attention to our supply and demand technique. It's a type of model we use a lot in all sorts of economics. But first, one of the ways to make sure that you use supply and demand correctly is that you have to understand what real-world events are referred to as supply or demand in a model. Because it turns out the real world doesn't always use the same terms as we do in economics. Let's start out with the term public saving. That's not something you're likely to hear on the news. Instead, on the news, you're likely to hear the term budget deficit or budget surplus. Let's go ahead and map that into our economic language. Let's do the easier one first. A budget surplus. The government is said to be running a budget surplus if it takes in more in tax revenue than it spends. Or using our algebraic notation, a budget surplus is equal to T minus G. So how does that compare to public saving? Well, that's of course the exact same formula. Budget surplus is what we call public saving in economics. So if you, for example, read a story that says the budget surplus is increasing from $200 billion to $300 billion, you should know to translate that in our model to public saving is increasing from $200 billion to $300 billion. The one where you have to pay attention to is the more common one, budget deficit. That's a situation where the government spends more than it takes in tax revenue. Or, using algebraic notation, a budget deficit is calculated as G minus T. So for example, if you read that there's a budget deficit of $100 billion, that could be the result of the government spending $500 billion, but only taking in $400 billion in taxes. 500 billion spending minus 400 billion taxes gives you a $100 billion deficit. Now here is where you have to pay close attention. A budget deficit is expressed as a positive number. But in our model, we talk about public saving. And if there's a budget deficit of $100 billion, translated into public saving, we would call that public saving is negative $100 billion. This is also important when it comes to changes. Let's say there's a story that the budget deficit is increasing from 100 to 150 billion. In the language of our model, that means public saving is decreasing from negative 100 billion to negative 150 billion. I'll raise this point towards the end of this lecture again to make sure all of us remember it. So that's our first term. Public saving, in the language of our model, means you should be listening to budget surpluses and deficits when it comes to the news. Let's practice that with a calculation. So here is a sample economy. Let's say it has a GDP of $10 trillion. Reminder, a trillion is 1,000 billion. Consumption is 6.5 trillion. Government spends 2 trillion. And there's a budget deficit of 300 billion. Budget deficit, that's that term where we have to pay special attention. Based on these numbers, I would like you to calculate the following. What is public saving, taxes, private saving, national saving, and investment spending? Now, because all of this comes out of the equations we've learned, there's actually many different ways in which you could solve this problem, because all these numbers only fit together correctly in one way. It's like a crossword puzzle. But one way that I think is easiest is to follow the order I just mentioned. First work out public saving, then taxes, then private saving, then national saving, then investment spending. Go ahead and pause the video now if you would like to give this a shot before I go through the answers. Alright, so let's have a look at the solutions here. First, let me take these numbers and make them a little bit more standard algebra usable. So I'll drop the dollar signs, I'll drop the trillion. Y is 10, C is 6.5, G is 2, and then that budget deficit. Remember, budget deficit is G minus T. Let's convert that into trillion. The budget deficit was 300 billion, that's 0.3. And now we go through the steps in the way I'd suggested. Let's find public saving. Well, if the budget deficit is 0.3, that means public saving is negative 0.3. Got to flip the sign to go from budget deficit to public saving. Next, let's find taxes. We know that T minus G is negative 0.3. We know that G is 2. So plugging G into this formula, solving for T, T must be 1.7 trillion dollars in taxes. Let's take that and go to private saving. That's defined as Y minus T minus C. We've got all of those terms by now. So 10 minus 1.7 minus 6.5, that's 1.8 trillion. Let's get to national saving. Again, we've got all of our terms here. Y minus C minus G, 10 minus 6.5 minus 2, national saving is 1.5 trillion. And finally, what's investment spending? Well, for a closed economy, that's equal to national saving. So also 1.5 trillion. In general, when you have to solve a problem of this type, it's typically easiest to write down the equations for those things that will be involved, as well as writing down all the variable names and associated numbers that you're given. The rest is a puzzle of plugging in typically easy subtraction and addition until you've reduced it down to the terms you need. All right, let's move on with discussing how to translate everyday language into the language of this model. We've got public saving out of the way. Next, let's talk about private saving. Reminder, that's the income that households have remaining after they've paid their taxes and engaged in consumption. So in real life, there are many things households can do that would qualify as private saving. For example, they can buy stocks or bonds. We've already discussed those financial markets. They can put the money into a bank in, let's say, a certificate of deposit, a CD, or go to another financial intermediary like a mutual fund. Even if they just let that money accumulate in a checking account, it's still being made available by that bank to other borrowers, so it still counts as saving. Now, here we have to be really careful when it comes to how economics uses language versus everyday life. Because the final term, investment, in economics refers to the purchase of new capital. So for example, if we have a big business building a big factory That's called investment spending. Or if we have a small business buying a small piece of equipment, that's still investment spending, because this is spending on products whose purpose it is to make more products. If you buy yourself a high-end computer for your business, let's say it's a web design firm, the purpose of this computer isn't to play Fortnite, it's to produce more goods and services. It's to produce websites. And finally, of course, building structures, factories, offices, but also houses, is referred to as investment spending. So here now we can run into that big disconnect between everyday language and economics. In everyday English, when we talk about investing, we often mean something like buying stocks and bonds, not in economics. That was on the last slide. If we have a household buying some additional stocks and bonds, we call that private saving. It's literally on the other side of the equal sign. Investment is reserved to the purchase of new capital. And we'll have some examples here at the end of our lecture as well. Right, we have now encountered our fundamental equation for today. National saving equals investment spending for a closed economy. We've talked about how it connects to real-world language. It is time to meet our model. This model is called the market for loanable funds. And it's just about the simplest model of a financial system you can build. So as always with a model, this is going to be an oversimplification of real life so that we can easily draw conclusions. And we're going to take it quite far here with oversimplifying. So in this model, we're going to do away with like all the financial intermediaries and most of the financial markets. Let's pretend our entire financial system just consists of one financial market where savers and borrowers interact with each other directly. Imagine, for example, a website. And everybody who wants to save money, they go to that website and deposit the money. And everybody who borrows money, they go to that website and borrow it out. Next, all these savers and borrowers have to go to this one market. And we're going to simplify by assuming that they all face the same interest rate. So you go to this website, there's one big interest rate. Everybody who saves money, that's what they get paid. Everybody who borrows money, that's what they have to pay. So there's no spread, no credit risk, no term risk, no FICO scores. It's the simplest possible financial system you could imagine. Again, this super simple version of a financial system is referred to as the market for loanable funds. And even though it's super simple, it is surprisingly effective at making predictions about the real world. So the class of model we'll now talk about is referred to as a supply and demand model. If you're new to supply and demand, pay particular attention. We'll be using supply and demand models a lot in this course. A supply and demand model separates out those who bring into the market versus those who take out of the market. That's what's referred to as supply versus demand. And being able to distinguish between those two is really important to using the model correctly. In the case of the market for loanable funds, the supply is the savings. We have two types of supply here. We've got our private saving, so that's the households with the extra income, and we have public saving. Together they form national saving. Notice public saving is often negative. Anytime a government runs a budget deficit, we have negative public saving. Nevertheless, we will leave it on the supply side of the model and simply make that number negative rather than flip it back and forth between the supply and demand side. So private and public saving, always the supply. In the supply and demand model, a very common way of representing this supply is to use what's called a supply curve. You draw yourself a graph with two axes. On the x-axis, you indicate how much is being supplied. So these national savings that are being supplied, we call them loanable funds. On the y-axis, you indicate what the supplier is paid for supplying. In the case of our financial market, that's the interest rate that they're being paid. So depending on what that reward, that payment, that interest rate is, our suppliers are going to change how much they supply into the market, how much they save. This relationship between the interest rate and the quantity of loanable funds supplied is referred to as a supply curve. You should expect this relationship to be positive, meaning for the line to be upward sloping. What that represents is if there's a change in the interest rate, the quantity of loanable funds supplied moves in the same direction. Let's say currently the interest rate is 3% and our savers are supplying $60 billion of loanable funds. The upward slope of the supply curve represents the following. If this interest rate were to rise, the reward for saving would increase. How do we expect our savers to respond? Well, if the reward for the behavior increases, we expect the behavior to increase. We expect them to save more. So for example, let's say this interest rate rises to 6%. You would now trace over to the supply curve at 6% and find a greater quantity of loanable funds supplied. For the sake of argument, let's call it $80 billion. So this supply curve represents, at all the different interest rates, what's the behavior of the suppliers? How much are they saving? In a moment, when we combine this with a demand curve, we will look at what happens if savers change their behavior. If at any given interest rate, they save a different amount of money. That will lead us to shift that supply curve. We'll get back to that. First, let's talk about the demand for loanable funds. Reminder, our borrowers are borrowing to finance investment spending. So we might have firms buying structures and equipment, or households building new houses. You know that in real life, borrowers can also borrow to finance consumption, but in our most simple version of this model, we're not going to allow that. We're going to restrict all borrowing to be for investment purposes only. This is the demand side of our model, and we're going to represent it as a curve using the same two axes as before. On the x-axis, how much are they borrowing, loanable funds? On the y-axis, the price they have to pay for those loanable funds, the interest rate. Now, when it comes to our demand curve, it has the opposite slope. It is downward sloping, representing an inverse relationship between the price you pay to borrow and how much borrowing you do. For example, let's say the interest rate is currently at 7% and our borrowers are borrowing $50 billion. If this interest rate were to fall, it is now cheaper to borrow, and you might expect borrowers to borrow more. So for example, if the interest rate were to fall to 4%, tracing over to the demand curve, we find a larger quantity of loanable funds, $80 billion. That's how you can recognize the supply and demand curve just by looking at their slope. Notice, by the way, how I keep referring to them as curves while the lines I'm showing you are straight lines. For simplicity, many of the curves we encounter in this course will be straight lines, but they don't have to be. They can have concave or convex shapes as well. So here's our market for loanable funds. Let's put it together now. The supply and demand curve on the same graph. Even if you've never seen a supply and demand model before, you can already tell what's going to be really interesting here. X marks the spot. There's one point where our two curves intersect. This is a very important point in supply and demand models. It's referred to as the equilibrium of the model. Literally, the point where the market is in balance. In other words, even though these supply and demand curves represent how our savers and borrowers behave at many different interest rates, there is one interest rate that will come about, the one that brings the market into balance, the one at the equilibrium. Only at this interest rate is the quantity that's being supplied equal to the quantity that's being demanded. You could imagine that, for example, if the interest rate were any lower, borrowers would want to borrow a greater amount than savers are willing to supply. This would give savers the opportunity to demand a higher rate of interest since they are all those extra borrowers, until the market is back in equilibrium. The equilibrium quantity of loanable funds effectively represents two numbers: how much is being saved and how much is being borrowed. But in equilibrium, those two numbers are equal, so we simply refer to them as the equilibrium quantity. The magic of a supply and demand model arises from being able to predict what will happen in this market if savers or borrowers change their behavior. What if savers save more? What if borrowers borrow more? And so on and so forth. We are now going to work through 3 examples of how a change in the market for loanable funds will affect the equilibrium. And I like to talk about this in 3 steps. The same 3 steps we'll be using for every supply and demand model we encounter during our course. Step number 1. Figure out the behavior that's being described. Is that something that affects the supply curve or the demand curve? Or in more advanced examples, both of them. So this is where you have to be able to take real-world language, such as households are investing in more stocks, and translate it into the language of the model. In the language of our model, that would be an increase in private saving or the supply curve. Step number 2. Once you've identified which curve is affected, figure out the direction in which it shifts. Increases will shift curves to the right, decreases to the left. I'll repeat that point in our first example. Step number 3. Once you've moved a curve in the right direction, the intersection will be at a different point. The equilibrium will have changed. And the equilibrium, of course, has 2 coordinates, one on the y-axis, one on the x-axis. In the market for loanable funds, those 2 coordinates will represent the interest rate in our economy and the quantity of loanable funds. But in general, economists like to refer to these 2 axes as the price and quantity axes, because every time we set up a supply and demand model, we like to put the quantity of the thing that's being traded on the x-axis and its price or value on the y-axis. So you'll often hear these referred to as P and Q axes as well. Let's go ahead to our first example. Here is our market for loanable funds that we just had, with an equilibrium interest rate at 5% and savers and borrowers being at $60 billion of loanable funds. So that represents both the quantity supplied and the quantity demanded. So savers are saving $60 billion, borrowers are borrowing $60 billion. That's what makes this market be in equilibrium. And now we want to predict what happens if there is a change in behavior. So let me tell you a story. Let's say the government decides it would be good if households saved more money for retirement. So they will incentivize saving more money. Let's say, for example, If you put some money into a savings account or into a 401k or into an IRA, the government will give you better treatment on your taxes. Our job is to predict the impact of this policy on our financial system. 3 steps. Step number 1. Which curve is affected? Well, if we incentivize saving more, we should expect that households will react by saving more. So where does household saving show up? Well, of course, we call that private saving, and that's part of our supply curve. Step number 1, it's the supply curve that's affected. Step number 2, we have to now shift it in the right direction. We want to represent the households saving more. Increases result in this curve being shifted to the right. Let me explain to you why that's the correct direction. Number 1, mathematically speaking. Before we made this policy, at a 5% interest rate, savers are saving $60 billion. Now, they get an additional benefit from saving money, so we expect them to save more. If the interest rate were to stay at 5%, they would not save 60 anymore, they would save more than 60. That's why we're going to the right. Speaking more generally, in supply and demand models, we put the quantity of what's happening on the x-axis. So anytime we shift a curve to represent that more is happening, we need to go in the more direction on the x-axis. Well, on the x-axis, more is to the right, less is to the left. That's why we always shift the curves in those 2 directions. Now, you're very used to looking at graphs where the amount of something happening is on the y-axis. So you're really used to graphs where more is up and less is down. In supply and demand models, more is right, less is left. Let's get to step number 3. Now that we've shifted the supply curve, the equilibrium is no longer in the same spot. It has shifted. In other words, while savers would save more right here at the 5% interest rate, the interest rate doesn't stay at 5%. That's because nothing has changed for the borrowers. For the borrowers at 5%, they only want to borrow 60 billion, but savers now want to save more than 60 billion. That means there's going to be downward pressure on interest, causing that interest rate to fall until we're back at equilibrium. So let's look at that new equilibrium quantity. The quantity has increased relative to the original 60 billion, but not all the way as much as the supply curve has shifted. It's increased by an amount in between that and the 60 billion original. In other words, our new equilibrium has 2 numbers associated with it. The interest rate. You can predict that as a consequence of these savings incentives, the interest rate will fall. And number 2, the quantity of loanable funds. You can predict that as a consequence of this policy, the quantity of loanable funds will increase. Every time we use supply and demand, that's going to be our 2 predictions. What happens on the price axis, what happens on the quantity axis. Let's go ahead and do another example. We'll take the market for loanable funds back to its original position, 5%, 60 billion equilibrium quantity. And now the story is the following. The government has decided it would be a good idea if more households built their own homes. So they've decided to make it more desirable to build your own home. Perhaps if you build your own home, there's less regulation you have to deal with. Whatever the specifics of the policy are, we are being tasked with figuring out the impact on our financial system. Step number 1, which curve is affected? Houses being built. In economics, that's referred to as investment spending. Investment spending happens on the demand side, so this time we're talking about the demand curve. Step number 2, which direction do we shift the demand curve? Well, if we incentivize investment, we should expect more investment to take place. more moves us to the right, always to the right. So let's take that demand curve and move it to the right. Finally, we've got a new equilibrium. This equilibrium is associated with a higher interest rate and a higher equilibrium quantity of loanable funds. Let's compare that with our first example. When we were incentivizing savings, interest rates fell and quantity of loanable funds increased. When we incentivized investment spending, interest rates rose and the quantity of loanable funds increased. So you can see shifting different curves affects the equilibrium of our market in different ways. And there's always two numbers whose change you have to look for. All right, we've got our first two policies out of the way. Let's go ahead and up the difficulty level to maximum now. What is the most difficult story as far as I'm concerned there is to analyze using the market for loanable funds? I would say it's the story of government budget deficits. Let's say the story is the government budget deficit, which is currently at, let's say, $100 billion. The government budget deficit increases from that $100 billion to $400 billion. Step number one, which curve is affected? Well, the budget deficit, of course, connects to public saving. And public saving is always on the supply side, regardless if we're looking at a deficit or a surplus. Step number one, this is going to be a supply side story. Step number two, which direction? Now we have to be really careful with how budget deficits work in this model. The language I just used was that the budget deficit is increasing from 100 to 400. But what's in our model? Public saving. So before we do anything, we have to translate this story into public saving. In the language of public saving, my story is public saving is going from negative 100 billion to negative 400 billion. That's a decrease. Negative 400 is less than negative 100. And decreases, of course, shift our curve to the left. So that supply curve is going to go that way, to the left. Even though when I talk to you in everyday language, I said that the budget deficit is increasing. In the language of this model, that means there's a decrease in public saving, which of course means national saving is decreasing. And that gets us to our final step. What's the impact of this increasing budget deficit? The equilibrium interest rate rises, while the equilibrium quantity of loanable funds decreases. Higher interest rate, lower equilibrium quantity of loanable funds. By the way, from your own experience, you might be aware that we've had episodes in the last 10 years, 20 years, where during times of great budget deficits, interest rates were also very low. That has to do with the phenomenon of the business cycle, recessions, which we'll talk about in a future lecture. Normally, when we're looking at big budget deficits, outside of the context of a business cycle, we would expect it to raise interest rates using the logic we just discussed. And this is a phenomenon important enough in macroeconomics that it has its own name. So one more time. In the long run, higher budget deficit leads to higher interest rates and less investment spending. This is referred to as crowding out in macroeconomics. The idea being, visually speaking, that the government is such a big borrower, they sort of muscle out the availability of funds for the private sector, and that's why investment spending falls. As we learned in our previous lecture, though, investment spending is important for the accumulation of capital which makes our economy grow. So there's always a concern that if budget deficits are too big in the long run, will they reduce long-run growth? Again, strictly a long-run concern. We'll learn towards the end of our course that if the economy is in a recession, this concern disappears, and the government running a big budget deficit during a recession might actually be helpful for the economy by balancing out what's happening during the business cycle. But those are future topics. For this lecture, we've now concluded discussing how to use the market for loanable funds and connect it to the language of everyday economics as opposed to technical economics. So let's leave this lecture with maybe something a little bit more fun to look at, some real world data. If we're talking about budget deficits and crowding out, it's always nice to look at the amount of debt that a government has. Because of course, for every year it runs a budget deficit, it is accumulating debt. The way that actually happens is that the government sells bonds. In the case of the US government, these bonds are referred to as treasuries. So over time, the total amount of bonds the government has out there among the public that they'll have to repay, that's what we refer to as government debt. Now you can look at the amount of government debt as a raw dollar number, but that's not always the best perspective because the economy as a whole is growing as well. So just because the number is bigger doesn't necessarily mean that it's a more significant amount of debt. And of course, inflation will also distort over time what that debt really represents in terms of purchasing power. So it's much more common in economics that we look at the amount of debt a government has in relation to the GDP of its economy. Because ultimately, government debt is repaid through taxes, and the GDP of a country is a good proxy for what's available to be taxed. So let's have a look at the US government's debt relative to GDP to get a feel for what high or low percentages might be. Here it is, all the way from 1790 until 2020. Of course, this ratio, debt to GDP, the numbers before the 20th century, GDP wasn't yet being measured in the modern sense. So all of that is estimated, but that's okay. We'll be close enough that the overall moves of this graph still make sense. And if you look at the seesaw pattern of debt to GDP, you'll notice a pretty clear pattern from the start of the Republic. Debt to GDP tends to be highest when there is a war going on, such as the Revolutionary War, the Civil War, World War I, World War II. That was the peak debt to GDP that the United States experienced. Notice it went over 100%. That's okay, we're using percentage here just to represent how much debt that is. Nothing happens if debt to GDP goes over 100%. A country doesn't go bankrupt or anything. In fact, if you look at Japan, for example, its debt to GDP is over 200%. And while wars are typically the places where debt to GDP is at its highest, sometimes really bad recessions, particularly those associated with a financial crisis, will also drive that number up. As we'll discuss in a future lecture, during particularly bad recessions, depressions even, one of the few ways we can use to make those shorter and less severe is to have the government engage in deficit spending. Here's the more recent financial crisis, 2008-09, that demonstrates that very dramatically. But you were probably also able to spot the Great Depression right here in 1929. And that concludes our lecture on saving, investment, and the financial system. I'll see you next time.